Every major financial catastrophe begins the same way, with a long, comfortable period where people convince themselves that risk has disappeared. That is where we are in early 2025. Asset prices are stretched to extremes across almost every category you can name. Stocks trade near record highs. Prime real estate in global cities is priced as if downturns no longer exist, and bonds of weak borrowers still find enthusiastic buyers. Beneath those prices sits a towering structure of debt. Governments run deficits as if there is no tomorrow. Corporations, from blue chips to speculative names, rely on constant refinancing. Households juggle mortgages, car loans, student loans, and credit cards. The total obligations in the system now exceed 3 times the size of the economy that supports them. The entire structure is balanced on the assumption that credit will always be available and asset prices will always be high enough to collateralize it. This belief did not appear by accident. It was trained. Since the last major crisis, central banks have repeatedly intervened whenever markets stumbled. Interest rates were cut to near zero and held there for years. Massive bond buying programs injected trillions of new dollars into the financial system. Each time fear appeared, liquidity washed it away. Investors learned a simple, powerful lesson. Any dip is temporary, and the authorities will not allow a true collapse. But policies that worked for one crisis sow the seeds of the next. Keeping rates near zero for so long encouraged everyone to borrow more and more. Vast quantities of debt were issued on the assumption that ultra-cheap financing would last forever. When inflation finally surged in 2021 and 2022, central banks had no choice but to reverse course. Interest rates rose at the fastest pace in decades. The cost of servicing existing debt jumped. Fragile borrowers began to feel the strain. Now, policymakers are caught in a trap of their own making. If they slash rates aggressively, they risk reigniting inflation. If they keep rates high, they raise the odds of widespread defaults. Either path carries danger. The comfort of the Fed will always save us era is gone, even if most investors have not yet realized it. This is the classic pre-crisis setup. Inflated valuations, record leverage, and an official toolkit that has already been heavily used. The spring is wound tight. The pattern that appeared before 1929 and 2008 is visible again. The only missing piece is the moment when something snaps and forces the system to reprice reality all at once. To see why the present feels so unstable, it helps to look backward at the last 2 great breaks in the financial system. While the details differ, the underlying rhythm is strikingly similar. Each time, a long boom convinced people that the old rules no longer applied. Each time, leverage quietly climbed to dangerous levels. Each time, a single shock exposed how fragile everything had become. In the 1920s, stock prices climbed year after year. Ordinary citizens opened brokerage accounts and bought shares on margin, borrowing heavily to amplify gains. Commentators spoke of a new era, powered by technology and industrial expansion, where major downturns were believed to be relics of the past. The language of permanence crept into financial commentary. When the break finally came in 1929, it was not just prices that collapsed. It was a story. The belief in endless stability died, and with it, nearly 90% of the market's value over the next few years. In the years leading up to 2008, housing played the starring role. Homes were advertised as can't-lose investments. People bought second, third, and fourth properties, often with very little money down. Complex mortgage products pushed credit to borrowers who, in earlier eras, would never have been approved. Global banks packaged these loans into securities that were stamped as safe by rating agencies. Once again, the narrative was that risks were contained and the system was stronger than ever. When defaults on subprime loans began to climb, those comforting assumptions evaporated. The banking system itself was dragged to the edge. What ties those periods to our present moment is not the specific asset at the center of the story, but the structure. Prices detached from fundamentals, debt layered on top of those prices, and a collective conviction that this time is different. Today, instead of a single bubble, we have a broad one. Stocks, upscale property, private equity valuations, and even some segments of the bond market all lean on the idea that liquidity will always be plentiful and buyers will always appear. The lesson from history is that such conditions rarely unwind gently. When faith in the narrative cracks, it often does so suddenly. The exact spark is hard to predict. The vulnerability is not. Just as in 1929 and 2008, the system has drifted far from safe territory, while most participants comfort themselves with the illusion that stability is permanent. The script is familiar, even if the cast has changed. When a bridge collapses, investigators may point to a specific bolt or cable that failed first. Yet the true cause is usually years of accumulated stress that left the structure unable to handle one more strain. Financial crises work the same way. The headline event that triggers the plunge is only the last straw laid on an overloaded system. One obvious weak point today is commercial real estate, especially office towers in major cities. The shift to remote and hybrid work has emptied floors that used to hum with employees. Many buildings now operate at a fraction of their former occupancy, yet they were purchased and financed based on the assumption of full or growing demand. Owners took out large loans at very low interest rates, betting that rental streams would easily cover payments. As those loans mature into a higher rate environment, the math reverses. A property that barely broke even at 3% financing becomes deeply unprofitable at 7%. Faced with that reality, rational owners sometimes choose to walk away. They hand the keys to lenders rather than pouring more money into an asset that no longer justifies its debt. Isolated defaults are manageable. Waves of them are not. Regional and community banks that loaded up on such loans can see their capital erode quickly if many properties simultaneously fall below the value of their mortgages. The banking tremors seen recently may well be previews rather than isolated episodes. Another potential spark lies in the world of corporate and sovereign borrowers. During the era of ultra-cheap money, companies and governments refinanced aggressively. They extended maturities, increased borrowing, and used debt to fund buybacks, acquisitions, and ambitious spending plans. Now, as those obligations roll over, weaker issuers face a harsh reality. The new terms are far more expensive. A single high-profile default, whether it is a household name company or a heavily indebted emerging country, can alter sentiment worldwide. Investors rush to dump similar bonds. Yields spike, making refinancing even harder for others. What began as one failure cascades into many. Finally, there's the unpredictable realm of geopolitics and shock events. History shows that wars, pandemics, and political crises can act as accelerants. They inject uncertainty into a system already on edge. When investors cannot estimate risk, they often react by selling broadly and seeking safety in cash or government debt. Markets that were already fragile under the surface can tip into freefall when confronted with a sudden, frightening headline. Any one of these stress points might be the first to snap, or the trigger could come from somewhere entirely unexpected. What matters is not the precise source, but the fact that the entire structure is highly flammable. In such an environment, even a relatively small spark can ignite a fire that spreads far beyond the place where it begins. When a serious downturn begins, it rarely feels like a complete disaster in the opening weeks. Often, the first leg down looks like a sharp but manageable correction. Markets fall 10 or 15%. Commentators argue over whether the selling is overdone, and many investors treat it as an opportunity to buy at a discount. This is the first phase. The initial jolt that signals the old equilibrium is gone. Then, as headlines cool and prices stabilize or bounce, a dangerous second act unfolds, the false calm. This period can last for weeks or months. Analysts appear on television to declare that the worst has likely passed. They point to historical charts showing that markets often rally after steep drops. Some of the earlier losses are recovered. Those who sold early feel foolish. Those who stayed fully invested feel relieved. Underneath the surface, however, stresses continue to build. The third phase is where a correction turns into a true crash, the cascade. Declines reach levels that trigger margin calls for leveraged investors. Because they borrowed to buy, their losses are magnified. Brokers demand additional collateral or force the sale of assets. These compulsory sales push prices lower, creating more margin calls in a self-reinforcing loop. At the same time, large pools of money, pension funds, mutual funds, hedge funds experience withdrawals as nervous clients ask for their cash back. To meet these redemptions, managers must sell whatever they can, adding to the downward pressure. In today's markets, algorithmic strategies intensify this process. Many trading systems are designed to react quickly to volatility and trend changes. As prices fall and volatility spikes, these algorithms may flip from buying to selling, amplifying each move. Stop-loss orders, placed by human investors to limit risk, are triggered all at once, turning orderly declines into sharp air pockets. Liquidity, which seemed abundant when prices were rising, disappears just when it is needed most. The fourth phase is the emotional bottom, where panic overwhelms analysis. News feeds are filled with stories of layoffs, bankruptcies, and failing institutions. Political leaders speak of extraordinary measures. Social media amplifies every rumor. In this environment, many people sell simply because they cannot bear the anxiety of holding on. Assets are dumped at any price. It is during this feverish capitulation that long-term bottoms are often formed, though they are only visible as such in hindsight. The final phase, once emergency policies take hold and the selling exhausts itself, is the slow climb back. Recovery rarely feels like a straight line. It is more often a painful slog, with rallies that many distrust and dips that reignite old fears. Yet over time, as balance sheets are repaired and confidence gradually returns, markets rebuild. Those who are wiped out near the bottom do not automatically participate in this rebound. Their capital is gone. Those who conserved resources through the storm emerge in a very different position. When panic dominates markets, the shock is not just financial, it is psychological and political. During the depths of past crises, people question not just their portfolios, but the stability of the entire system. Bank lines, protests, and intense public anger became part of the landscape. In a future crash, especially one following years of rising inequality, the social mood could be even more strained. As conditions deteriorate, authorities are forced into action. Central banks provide emergency liquidity to banks and key markets. Interest rates are slashed, sometimes back to zero. Special lending programs are created to prevent solvent institutions from failing simply because they cannot roll over short-term funding. Legislatures pass stimulus bills aimed at shoring up demand, supporting the unemployed, and preventing a cascade of business failures. The numbers involved can be staggering, with trillions committed in a matter of months. These measures do not instantly restore optimism. At first, they simply stop the bleeding. Bank failures may slow. Credit markets begin to function, albeit cautiously. Stock indices oscillate violently as investors try to discern whether the worst has passed or another wave of trouble is coming. Economic data, which reacts more slowly than markets, continues to worsen even as equities occasionally bounce. The disconnect can be disorienting. Over time, however, the combination of policy support and natural adjustment starts to have an effect. Companies that can survive do so by cutting costs, renegotiating debt, or raising new capital. Households adjust spending, build savings when possible, and gradually reduce the most burdensome obligations. New businesses form to fill gaps left by failed competitors. Innovation does not stop simply because markets crashed. In some cases, it accelerates as people search for new solutions in a changed environment. Yet, recovery comes with a bill. Massive stimulus and emergency programs often leave governments more indebted than ever. Central bank balance sheets swell with assets purchased during the crisis. When the immediate danger has passed, society must confront hard questions. Should taxes be raised? Should spending be cut? Should inflation be allowed to run hotter to erode the real value of debt? Each path has winners and losers, and the political debates can be fierce. The individuals who were hit hardest during the panic, those who lost jobs, homes, or small businesses, do not automatically benefit from the statistical recovery. Their personal balance sheets may take years or decades to heal, if they ever do. Meanwhile, new concentrations of wealth can emerge among those who were able to buy assets at distressed prices or expand operations while others were shrinking. The crisis reshapes who owns what, and those changes often endure long after the headlines fade. In every major downturn, a massive transfer of wealth takes place. It is not usually orchestrated by a single actor, nor is it necessarily illegal or hidden. It happens through the workings of the cycle itself. As leveraged owners are forced to sell into falling markets, stronger hands with cash and patience step in to buy. Assets change owners at steep discounts. When recovery eventually comes, the new owners capture most of the upside. Those who suffer the most tend to share common traits. They are heavily exposed to volatile assets relative to their income and savings. They rely on continued price appreciation to meet future goals. They carry significant debt, often secured by the very assets that are falling. Many are ordinary middle-class households who bought homes near the peak, or who kept almost all their retirement savings in equities because that had worked for years. Others are small business owners who pledged personal assets to secure loans. When the downturn hits, they do not have time or flexibility. They must meet payments, even if it means selling into a collapsing market. By contrast, those who emerge stronger often share a different set of characteristics. They maintain some portion of their wealth in very liquid, low-risk assets that hold up when markets fall. They resist the temptation to use maximum leverage, accepting slower gains in good times in exchange for survival in bad times. They study history enough to recognize that long periods of calm can be followed by violent reversals. Emotionally, they prepare themselves for the possibility that the best buying opportunities will appear when the news flow is most frightening. This does not mean that only billionaires can navigate a crisis successfully. The underlying principles, avoiding excessive leverage, keeping a margin of safety, diversifying, and planning for shocks, apply at every scale. But history does show that large pools of capital, such as major investment firms and cash-rich companies, are often uniquely positioned to act aggressively when others cannot. They have teams dedicated to identifying distressed opportunities. They can wait years for a thesis to play out. When assets are repriced sharply lower, they can write checks while others are scrambling to survive. It is important to emphasize that no outcome is preordained. Patterns in markets are powerful, but they are not destiny. Policy choices, technological developments, and collective behavior can alter the shape and severity of any future downturn. Still, the broad outline booms leading to complacency, leverage building, shocks exposing fragility, and wealth shifting from the overextended to the prepared has repeated many times. Understanding this pattern is not about predicting an exact date or index level. It is about recognizing that the rules of the game change when the cycle turns. Strategies that worked in the late stages of a boom chasing momentum, maximizing leverage, assuming central banks will always rescue markets, can be disastrous in a bust. Conversely, habits that seem overly cautious in good times, holding cash, limiting debt, thinking in decades instead of months, may be the very traits that place you on the right side of the transfer when the next major reset arrives.